Good afternoon. Welcome to the 2019 June Quarterly Superannuation Update. My name is Mailene Wheeler and I am the Associate Director in Vincent's Superannuation Advisory Team. I'll just wait a few seconds to make sure everyone has been able to log in. And while we do that, I'll just leave our disclaimer slide up. Just a reminder that the information contained in this presentation is intended for general use only and guidance only. None of the information presented should be considered as formal advice, and any imputation in that regard is specifically rejected. Here's a slide with my contact details if you need to contact me in regards to anything in the self-managed super space. And let's have a look at our agenda for today. So as part of the June 2019 Quarterly Superannuation Update, we will look at upcoming important superannuation dates, super law that takes effect from 1 July 2019. We'll have a quick look at just a few of the ATO updates to the website that specifically relate to the superannuation. We'll look at the changes that have happened to the reporting of Part A and Part B qualifications of SMSF financial statements to the ATO in the 2019 tax return. We'll also look at the contribution caps for the 2019 and 2020 year, along with some other key super rates and thresholds that apply from 1 July 2019. All right, so let's start with some important super dates that apply. So the following table highlights the upcoming key superannuation tax related lodgement dates. This list of key dates is not comprehensive and is a guide only. So we have on the 29th of July, the due date for any super guarantee payments for the June quarter from employers on behalf of their employees. These need to be made to the super funds by this date. This is also the due date for a quarterly T-bar for any SMSFs that are required to report quarterly. Note that if any members of your self-managed super fund had a total super balance of $1 million or more on 30 June and the year before any member starts their first retirement phase income stream, that you must report any transfer balance account events on a quarterly basis. All right, we've also got 28th of October as the due date for super guarantee contributions from employers, and then 31 October 2019. If you have any prior year tax returns outstanding for your self-managed super funds, this is the date that your 2019 tax return is going to need to be lodged and paid. If you are a newly registered fund and you've been given this date, your 2019 SMSF annual return will also be due on this date. And if you have lost member reports that need to be reported, you need to, for the period 1 January 2019 to 30 June, you need to be lodged on this date, as well as the lodging Departing Australia Super Payments annual report. So please note that this table does not include specific lodgement dates in relation to activity statements and PAYG instalments. Okay, so let's have a look now at the super law changes that have applied from 1 July 2019. So the Treasury Laws Amendment Protecting Your Superannuation Package Bill 2019, it received a royal assent on the 12th of March 2019. So from 1 July 2019, the new Protecting Your Super laws came into effect. These laws included several measures designed to ensure that super account balances are not being unnecessarily eroded by fees and insurance premiums, particularly for accounts that have a low balance or have been inactive for a certain period. So super providers, excluding self-managed super funds and small APRA funds, will now be required to automatically cancel insurance cover for inactive super accounts. These rules prevent super funds from providing insurance cover to you if your super fund account is inactive, unless you specifically elect to keep your cover. So under these rules, an account will be considered inactive if it has not received contributions or rollovers for 16 consecutive months. So it's vital to also remember that if you're in pension phase, you're not going to be making any contributions. So if you have any insurance, you need to get in touch with your retail or industry fund to let them know if you'd still like insurance. So inactive super accounts that have a low balance, they will be closed from 1 July 2019. So many inactive accounts with a balance of less than $6,000 will be closed and the balance will be transferred to the ATO. The ATO will then use data matching to connect these super accounts with an active super account of the member wherever possible. A cap will also apply on accounts with low balances. So fees will now be capped at 3% per annum for accounts with a balance of $6,000 or less at year end, And no exit fees will apply when a member decides to switch funds. Okay, also from 1 July 2019, the Treasury Laws Amendment Work Test Exemption Regulation 2018 was registered on the 7th of December 2018. So this means that from 1 July 2019, any retirees aged between 65 and 74 with a superannuation balance below $300,000 will be allowed to make voluntary super contributions for the first year that they no longer meet the work test requirements. So retirees can only take advantage of this once. They won't be able to make contributions in subsequent financial years. This opportunity is also only available in the year immediately following the year in which the retiree last met the work test. Okay, catch-up concessional contributions. So catch-up concessional contributions allow eligible Australians to put more into super. This is the first year that individuals can make additional catch-up concessional contributions using the unused concessional contributions cap amount from the previous year if they are eligible. So the ability to make a catch-up concessional contribution applies to people whose total superannuation balance was less than $500,000 at 30 June of the previous financial year. The 5-year carry forward period started on 1 July 2018. So the 2019-2020 financial year is the first year where you can actually make an extra concessional contribution using the balance of any unused super contribution cap from a prior year. The work test rules still apply for people aged 65 or over, and the usual notice requirements continue to apply for personal deductible contributions. Any unused amounts can be carried forward regardless of your total super balance, but they expire after 5 years. Additionally, where a member meets these conditions, their increased concessional contributions cap is used to determine the maximum amount that can be split with their spouse. The contribution splitting is applied. So even though the cap each year is $25,000, if your bring forward cap allows you to contribute $50,000 and you are doing contribution splitting, you could do up to 85% of this $50,000 split with your spouse. Okay. The new means testing of the lifetime income streams. So a new means testing regime for lifetime income streams commenced on 1 July 2019 for lifetime income streams purchased from that date, due to the passing of the Social Services and other legislative amendment supporting Retirement Incomes Act 2019. So from 1 July 2019, 60% of the payments from a lifetime income stream will be assessed under the income test, whilst under the asset test, 60% of the purchase price will be assessed until the income stream recipient reaches their threshold day, or 5 years from commencement. The threshold day is currently calculated to be age 84, after which 30% of the purchase price is assessed under the asset test. Lifetime income streams purchased prior to 1 July 2019 will continue to be assessed under the current regime. All right, now let's have a quick look at some of the ATO website updates, as well as looking a little bit more at MyGov. Okay, so with the ATO updates, making a Div 293 election. So the process to release money from super fund accounts to pay the additional tax on your concessional contributions, which is the Div 293 tax, changed on 1 July 2018. Since then, a member must send the Division 293 election form directly to the ATO, not to the super fund. So if the election form is sent to the fund, it will be rejected and returned to the sender. It's important to note this for any of the self-managed super funds out there. So the quickest way to make an election is online via the MyGov website or apps. It is important that a SMSF does not pay a member's Div 293 tax debt until they have received the appropriate paperwork from the ATO. Otherwise, the payment could be deemed to be an early release of super. The ATO has released an update on their website about the SMSF annual return changes. So some new questions have been added to the 2018-2019 SMSF annual return, and we'll look at a specific section of that shortly. They also released the March 2019 SMSF quarterly statistics. They have also updated their guidance in relation to the valuation of SMSF assets. So the main details of the changes are that they have deemed that it is appropriate to use a reasonable estimate of the commencement value of a pension when it commences partway through a year, or for the transfer balance cap reporting purposes, if the pension commences on 1 July and you need to report this event by 28th of October, and it's just not possible to receive a full valuation by then. However, any estimate valuations used for those purposes cannot be relied upon when you're preparing the SMSF financial accounts and you're calculating the fund's exempt current pension income. There's more information available and all the links are included on the slide. And also, there is some new functionality that is now available for self-managed super fund members who use the ATO online service via MyGov. So it's giving fund members visibility of their super transactions. The greater visibility of super is aimed to help Australians gain more control over their retirement savings, including the ability to identify if your super is not being paid. ATO Online will now display employer contributions made to an SMSF on the fund transaction screen, and the contributions will now just simply be reported as employer contributions rather than the existing categories that they had, which were super guarantee, voluntary, salary sacrifice, as SMSFs do not need to report to this level of detail. It's also worth noting that the ATO has announced that it will be developing an online SMSF trustee test that individuals would have to complete before they can legitimately establish an SMSF. And that hasn't made it to the slide. That was something that was announced yesterday. Okay, so now let's have a look a little more at what SMSF members can see and do using their MyGov and ATO online. So let's start with what is MyGov. So MyGov is the whole of government authentication solution that is accessed through the website my.gov.au. So MyGov enables individuals and sole traders to link a range of Australian government services with one username and password all in the one place. So you can log in, you can see your Medicare, you can see Centrelink, you can see ATO. You must link your MyGov account to the ATO if you want to use the ATO online services. It also includes a MyGov inbox. So once you register, you receive messages from the government agencies that have been linked to your MyGov account to this email box. It also includes a Tell Us Once service, which is my personal favourite, which lets you update your contact details for multiple linked government agencies all in the one go. Yesterday, though, the ATO did release on their website an announcement that they have identified some registered and unregistered tax agents who have been using the personal login details to access ATO Online via MyGov to lodge tax returns on behalf of their clients. This is just a reminder that MyGov and the ATO Online is not an approved lodgement channel for registered agents, and this is considered a breach of the ATO Online terms and conditions. You should never share your MyGov sign-in details with anybody else, even your tax agent. So what can SMSF members see and what can they do using the ATO Online via MyGov? Well, you can now see your employer contributions reported by the super fund, as mentioned before. You can see your employer's super guarantee obligations on your income statement. You can see your super fund accounts and balances and your super balance as at 30 June of the previous year. You'll be able to find your lost and ATO held super, and you can transfer these amounts into active super fund accounts all through MyGov. You can see bring forward arrangement information for the non-concessional contribution cap. You can view your transfer balance cap details. You could elect to release money from super for your Div 293 tax liabilities or excess contributions tax. You could apply for the First Home Super Saver, the FHSS scheme, and you can also see related information, including your FHSS scheme tax liability, and establish and view payment plans. You're also able to apply to access some super early in very limited circumstances, and you'll also be able to see any super accounts that you have closed on or after 1 July 2018. All right. So as we mentioned in the previous slide, there have been some changes to the SMSF annual return for the 2019 financial year. One of these questions is to do with the SMSF annual return Part A and Part B qualifications. So in prior years, SMSF trustees were only asked on the SMSF annual return whether Part B of the audit report was qualified. The 2019 SMSF annual return will now also ask whether Part A of the audit report was qualified. Part B of an auditor's report gives the auditor's opinion on whether the fund has complied with super laws, while Part A of the report gives the auditor's opinion on whether the fund's financial statements are fairly presented. So let's have a little look at a bit more of what Part A qualifications would be. So in conducting Part A of the audit, the auditor will seek to obtain sufficient and appropriate evidence that the assets and liabilities of the fund exist and are clearly owned by the fund or are obligations of the fund in the case of liabilities, that they are appropriately valued in the financial statements according to the relevant accounting standards and ATO requirements, that they are appropriately classified in the financial statements according to the relevant accounting standards, and that no material assets or liabilities have been excluded. So trustees must now answer yes if the audit report was qualified at Part A and or Part B, regardless of the auditor's reasons for the qualifications. In prior years, trustees could answer no if the only reason the auditor qualified Part B was because they could not confirm the information provided to them, for example, opening account balances. This is no longer the case. The answers must correctly convey the auditor's written opinion. The ATO has advised that this information will help them build a more complex risk profile of the SMSF population, and that this information is only one of the factors that they would take into account in making a risk assessment of the fund. On their website, they have stated that they would generally not raise a fund audit or review case based solely on a qualification of Part A of the auditor's report. However, if you receive a qualified audit report from your SMSF auditor, you should work to rectify any issues if possible. You can also make voluntary disclosures to the ATO so that if they were to commence an audit, they will take your disclosure into account in determining any enforcement action and the appropriate level of remission of administrative penalties. Contribution caps. So the general concessional contributions cap remains unchanged at $25,000 for all individuals, regardless of age. Concessional contributions are your before tax contributions that are made into your super fund by your employer, such as the 9.5 super guarantee, salary sacrifice amounts, or any personal contributions. These contributions are taxed at 15% as they enter your super fund. Most taxpayers under the age of 75 have the opportunity to claim a tax deduction for personal super contributions made to a complying fund or RSA. So this means that an individual can make up the difference between their employer super guarantee payments and the concessional contributions caps and personally claim this as a tax deduction. Taxpayers aged 65 to 74 are still required to meet the work test, which requires that they have worked a minimum of 40 hours and 30 consecutive days in the financial year before the super fund can accept the contribution. If you are 75 years or older, you can only claim a deduction for contributions you made on or before the 28th day of the month following the month in which you turn 75. Also, members of the Commonwealth Public Sector Superannuation Scheme and untaxed funds such as a CPF, a constitutionally protected fund, or certain funds that offer defined benefit interests will not be eligible to claim a deduction for contributions made to these funds. If you're a member of one of these funds and you wish to claim a deduction, you can choose to make a personal super contribution to another eligible fund. Non-concessional contribution caps. So the non-concessional contribution cap, which is the contributions for which no tax deduction has been claimed, also remains at 100% for members. The non-concessional contributions cap will be nil for a financial year if your total super balance is greater than or equal to the general transfer balance cap at the end of 30 June of the previous financial year. The transfer balance cap for the 2019-2020 year remains unchanged at $1.6 million. So basically, if you've got over $1.6 million, you can't put any more non-concessional contributions in. If you have a balance of $1.6 million, as I've just said, you can't put any more non-concessional contributions in. And if you were to, these would be treated as excess non-concessional contributions. So when you're approaching the $1.6 million cap, it's really important that you take care in regards to the bring forward rules, as they are now restricted under the transfer balance cap rules. So the non-concessional contributions cap amount that you can bring forward, and whether you have a 2 or 3 year period, depends on your total super balance at the end of 30 June of the previous financial year. For 2019-20, to access the non-concessional bring forward arrangement, you must be under 65 years of age for 1 day during the triggering year, which is the first year, and your total super balance must be less than $1.5 million at the end of 30 June 19. The remaining cap amount for 2 or 3 of a bring forward arrangement is reduced to nil for a financial year if your total super balance is greater than or equal to the general transfer balance cap at 30 June of the previous year. So the next slide will clearer show how the bring forward arrangement works. So if your total super balance on 30 June 2019 was less than $1.4 million, for your first year, you could contribute $300,000 in, triggering the 3-year bring forward arrangement. If your balance was between 1.4 and 1.5, you could put $200,000 in the first year because you've triggered a 2-year bring forward period. If it's between 1.5 and less than 1.6, you can only put in $100,000. No bring forward period is applicable. The general non-concessional contribution cap applies. And reiterating yet again, if you've got over $1.6 million, you don't have a cap for the non-concessionals and you can't use any bring forward. All right, so what other contribution caps are there that apply from 1 July 2019? Super CoContribution. So the Super CoContribution is designed to assist low to middle income earners save for their retirement. If you're eligible and you make personal super contributions during a financial year, the government will match your contribution with a Super CoContribution up to certain limits, which are all based on income thresholds. The maximum Super CoContribution entitlement for the 1920 year remains unchanged at $500. However, the lower income threshold has increased to $38,564, and the higher income threshold has increased to $53,564. Downsizer contributions. So individuals aged 65 or over have the ability to make a non-concessional contribution to their super fund of up to $300,000 from the proceeds of selling their home. These contributions will not count towards their non-concessional contribution cap, and the individual making the contribution will not need to meet the existing maximum age, the work, or the $1.6 million balance test that usually apply when someone aged 65 years or older makes a contribution to super. If the home is in joint names, both members of the couple can contribute to their super, thereby allowing up to $600,000 to be contributed into super. To qualify, the following conditions must be met. The contract for the sale of the property has to be dated after 1 July 2018. The property sold must have been owned by the individual, either solely or jointly, for the past 10 or more years. The property must have been the principal residence of the individual. The contribution must be made to the fund within 90 days of the disposal. The individual must choose to treat the contribution as a downsizer contribution, and they must notify their super provider in the approved form of choice at the time that the contribution is made, and the individual cannot have used the downsizer contribution in relation to an earlier disposal of a main residence. So there's some recent data that's been released in relation to downsizer contributions. So it's interesting to note that the Assistant Treasurer, the Honourable Michael Sukkar, announced on the 28th of June 2019 that total downsizer contributions made by older Australians has now reached $1 billion. The key recent data shows that 4,246 individuals have utilised this measure, that 55% of these contributions have been made by females, while 45% from males, and that individuals from every state and territory have made a downsizer contribution, with the top 3 states being New South Wales at 31%, Victoria at 26%, and Queensland, we've come in third at 24%. All right, now let's have a look at some of the other super rates and thresholds that apply. So the ATO has published the key superannuation rates and thresholds for the 2019-2020 year. So the superannuation guarantee, it's the compulsory super contributions that your employer has to make on behalf of you. So the super guarantee is currently set at 9.5% of an employee's ordinary time wages or salary. This rate is scheduled to progressively increase to 12% over time, which is outlined in the table on the next slide. So you can see that for the 2021 year, it will remain at 9.5% before gradually increasing by 0.5% every year until it reaches 12% in the 2026 financial year. All right, superannuation guarantee. So the maximum super contribution base is used to determine the maximum limit on any individual employee's earnings base for each quarter of any financial year. So employers do not have to do the 9.5% super guarantee for any part of the earnings that is above this limit. The maximum super contribution base for the 1920 year is $55,270 per quarter. CGT cap. So an individual may contribute certain proceeds from the sale of assets used in the course of carrying on a small business and elect for these to count towards a separate lifetime CGT cap rather than falling under the concessional or non-concessional caps. The CGT cap amount for the 2019-2020 year is $1,515,000. Now, an individual's total super balance will not impact your ability to contribute a CGT exempt amount. You just have to meet the conditions under the CGT rollover. Now, CGT contributions once made, they count towards your total super balance, so they may then impact a range of other measures. For example, your future non-concessional cap. So it's really important that if you are using a CGT cap, that you talk to your advisor about the timing of any CGT and non-concessional contributions to ensure that you're getting the most you can into super. Okay, so Division 293. So this is an additional tax of 15% that is paid by people whose combined income and concessional super contributions exceed a Div 293 tax threshold. Tax payable of 15% is then levied on the excess over this threshold or on the super contributions, whichever is less. For the 2019-2020 year, the Div 293 threshold remains unchanged at $250,000. Superannuation benefit caps. So if you've reached your preservation age and you withdraw super before you have turned 60, the low rate cap is a limit on the taxable components of your payments that can be taxed at the concessional super rate of 15%. The low rate cap for 2019-2020 has increased from $205,000 from the 18-19 year to $210,000. The untaxed plan cap is the limit that is set on the concessional tax treatment of benefits paid as a lump sum from untaxed elements. The untaxed plan cap amount is indexed each year. Gosh, can't talk today, and is $1.515 million. Related party limited recourse borrowing arrangements. So the ATO's safe harbour interest rates for a related party limited recourse borrowing arrangement, or an LRBA, for the 2019-2020 financial year have increased. So it's now 5.94% for the real property and 7.94% for any limited recourse borrowing arrangements that were used to acquire listed securities. Okay, some of the other superannuation thresholds and rates to consider for 2019-2020. So in order to access super benefits, it's generally restricted to members who have reached their preservation age and also satisfied a condition of release. So with it being the start of a new financial year, we thought it would be a good time to recap on what those preservation ages are. So a person's preservation age ranges from 55 to 60 and is dependent on your date of birth. So the table below will show that if you're born before 1 July 1960, your preservation age is 55. It has increased by a year for each year up until anyone born after 1 July 1964. We have to wait until we reach age 60 to get to our preservation age. All right, so what are the most common conditions of release? So usually it's retirement on or after your preservation age. It's attaining age 65. It's attaining your preservation age and starting a transition to retirement income stream, or a TRIS. It's being over 60 and terminating a gainful employment arrangement. It could be permanent incapacity or a terminal medical condition. All right, so at Vincent's, we recognise the importance of trustee education and being supported with resources to assist you to feel informed and in control of your self-managed super fund journey. As a member of the SMSF Association, which is the independent professional body that represents Australia's self-managed super fund sector, we now have the following SMSF trustee resources available on our website. So if you were to log into vincents.com.au/superannuation-advisory-resources, you can now find detailed SMSF Foundations course and a guide to establishing a self-managed superannuation fund. There are key compliance resources relating to thinking about SMSFs, setting up an SMSF, contributions and rollovers, investment education, paying benefits, administering your super fund, reporting for your superannuation fund, and estate plan, because superannuation is separate from your will. There is an archive of important news articles and updates on topical SMSF issues, including legislation and annual federal budget information. And there's information on upcoming live events presented by the SMSF Association that you may wish to attend. So we're really excited to launch this today, and we hope that you find these resources valuable to complement our advice services and keep you up to date. Please feel free to contact us to discuss any questions you may have in relation to the information provided and how it may affect your specific circumstances. In addition to superannuation advisory services, Vincent's also, I've lost a slide. But we also offer assurance and risk advisory, business advisory, corporate advisory, financial advisory, forensic services, insolvency and reconstruction, as well as lending solutions. That concludes today's quarterly superannuation tax update. Vincent's Superannuation Advisory is here to work with you to ensure that your SMSF structure is fit for purpose to achieve your desired outcomes. We can help you with SMSFs, structuring and strategy advice to help ensure that your investments are held in the most tax-effective way, and when they are held in super, that they comply with all the relevant super legislation and regulations that apply. We can help you with retirement and estate planning, including facilitating the preparation of death benefit nominations and trustee updates. We can work with you and your lawyer to ensure that your superannuation estate matters are set up to achieve your desired goals and go to your nominated beneficiaries. We also offer a range of consultation services to both SMSF trustees, accountants and lawyers, whether it be assistance with highly technical compliance matters or assisting with super or divorce settlements. All right, if you have any questions, please do not, there we go, my slides were out of whack. If you have any questions, please do not hesitate to contact me on the details listed here, and a copy of the presentation slides will be available if you request. Thank you.